Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Laurie Calvasina of RBC writing, globally, our analysts have a slightly bullish tilt in their outlook for performance over the next 6 to 12 months. Within the US, performance outlooks on financials are most bullish, followed by materials and healthcare. Laurie's with us around the table. Laurie, good morning to you.
Thanks for having me.
Good to kick off the trading week with you. One of the big sectors that comes up repeatedly around this program, the financials. Yep. People seem to like the financials. Earnings season has started. You, like me, like us, we look at the banks as some kind of read on the broader economy. Yep. What's it telling you right now?
So I thought the results we got on Friday affirmed the soft landing thesis. I mean, that's really all I was paying attention to be honest, when we were going through the transcript. And I think, we sort of heard, on the one hand, the consumer is still pretty strong. We had one bank tell us, we're eagerly looking for those signs of weakness and we're just not finding them. And I think that, really reflects what a lot of us macro forecasters have been telling our own clients lately. Like, we're looking at it, we hear all the concerns, we are just not seeing it in the data, we are just not hearing it from the companies.
Which presents its own problem. You look at high yield spreads, super tight, investment grade spreads super tight. The banks are saying nothing to see here, no problem. So as an investor, if you've been sat in cash, you're looking at stocks at all-time highs, credit spreads at very, very tight levels, and you're wondering what on earth do I do? What do I do?
I think it's a question of your time horizons, right? And if I think about my own targeting process, we're a little bit over my 5,700 number right now for this year. And I feel pretty neutral in the short term. I don't feel bearish by any stretch, but valuations feel full. Sentiment feels pretty full to me. AAII hit, I think it was 24% on the 4-week average last week, 28% on the 1-week number. That's a 1 standard deviation event. So I don't necessarily feel like you need to be chasing at this particular moment. That being said, when I walk through the valuation math for next year, if I keep a pretty steady multiple and I just bake in earnings growth, assume a pretty good economy, I can get to 6,200 easily. On my, I have a below consensus earnings number of 269 now. If I use consensus earnings, which is over 280, I can get you to like 6,500, 6,600. So I think you buy dips is the way to think about it. And I think if you don't really care about the short term, sure, maybe you can go ahead and hold your nose and buy.
There is a question about which dips do you buy, because there has been a very segmented market where you have basically big tech rotating in and out of favor, and then you have the rest of the 493 that are playing catch up in fits and starts. How much do you lean into this sort of rotation, this broadening out trade at a time where you do see some earnings growth, but it's patchy?
So look, I think if you're thinking about the rest of the S&P 500 x the Mag 7, I feel much better about that right now than necessarily small caps. But I do think the earnings need to come through, and we're in just sort of this weird earnings growth environment right now for the bits and pieces. And I think that's why the leadership handoff has been such, fits and starts. So Mag 7 earnings growth is decelerating on forward estimates. However, those estimates have been improving recently. If you look at the rest of the market, those estimates have been stagnating. So, on the one hand, we've got this decelerating earnings growth environment for this previously hot part of the market, and that makes everything very jittery, right? It makes us vulnerable to downside. But it's fighting back very hard. I need the other side of the market, the financials, the energy companies. We need them to fight back harder this reporting season.
One thing that struck me about the earnings that we heard, in particular from JP Morgan, but also from Wells Fargo, is just the lack of clarity, the lack of visibility. And I'm guessing we're going to hear that more from other companies. We have already. How difficult does that make your job?
It makes it very difficult. And on the one, I was talking to someone about corporate confidence over the weekend, and I said, on the one hand, there's this resilience, the faith in the ability to execute and control what you can control. On the other hand, we are seeing companies talk time and time again about uncertainty from things, about the path of interest rates. Well, we thought we settled that, maybe not. Let's see. We've got the election coming up, and I asked a company this recently at one of our conferences, and I said, what are people waiting for, with this election? What outcome do they want? What policy issues are they focused on? And eventually the company said, well, I think they just want the event to pass. So, our customers know what they're dealing with. And I think that, for better or worse, is where we are. And we heard one of the banks actually allude to that idea on Friday as well.
Can we stay on that theme? Do you sense a real sense of paralysis, that people are really holding back, just waiting for this event to clear?
So if I think about the hedge funds, I don't get the impression they have been doing a lot. They may be starting to do more now that we're within a 30-day window. You are seeing the VIX move up a little bit. That indicates to me that maybe the fast money crowd is starting to do a bit more. If I think about my long-only clients, I had one person say to me recently, said, I don't know what's going to happen on the election, on election. I don't know what the outcome is going to be. How can I possibly do anything right now? And so I do, on that kind of longer-term money, I do see, I don't know if I call it paralysis, but I see healthy wait and see.
And whether we actually get an outcome. I say waiting for this event to clear. I've got no idea how long it takes for this event to clear. It could be weeks.
Well, I think it's the election outcome itself. Are we going to go and fight it in the court system the way we did back in 2000? Now, what's interesting about 2000 is we did not get our typical sell-off heading into the election. We also didn't get our typical pop after the election. And I think we actually resolved that pretty early on in December. And the market still never got, that sort of relief bounce. So that's something to watch in here as well. But let's even take it a step further. The legislative process is how laws are determined. I feel like I keep having to remind people this who don't sit in the U.S. It's not so much, if Anne-Marie were here, right, this laundry list, this, that they're all throwing out. These are just negotiating points and ideas. We have to actually see what Congress is going to look like. We have to see which of this laundry list they actually care most about. And, if they're going to pick and choose a couple of things, what are those things going to be? So we're going to be waiting and seeing for a while.
The paralysis that you're talking about implies almost binary outcomes or potentially very different outcomes between one candidate and another, or between one legislative outcome or another. How different are the ranges of outcomes that people are trying to map out in the C-suite?
So, it's funny. I probably have a slightly different view on this. I only look at policy. I don't look at personality. And we've gone through and just really tried to compare all the campaign documents, not what they're saying in every single rally, but what's actually been put on websites, what's been put on papers, what's been said on dedicated economic speeches. And I do feel like there are some clear differences on things like corporate tax policy, things like energy policy. But tariffs, I feel like, as opposed to them being, left and right, it's sort of on one side of the spectrum, with different extremes. I do feel like I'm not seeing either candidate necessarily talk a lot about in what I call sort of industrial-related stimulus, which was a big feature of the last two campaigns, sort of reinvesting in infrastructure and things like that. I'm seeing a lot of consumer-led initiatives. So I feel like, we're kind of ending up on the same page on a lot of things. Like they're both talking about things like home building.
What strikes me is when we talk about what the big fears are of people, they talk about geopolitics, they talk about the unknown around the potential outcome of the election, they talk about interest rates. And then you look at things like the AAII investor survey, and there's an incredible amount of confidence. You take a look at what they're buying, there's an incredible amount of confidence. Where is this paralysis showing up? If the consumer is still spending and companies are reporting good earnings, where is it showing up?
I think part of it is maybe coming from overseas. And one of the things I've noticed is that Russell 2000 futures positioning on the CFTC data has suddenly just surged, right? And that's when that tends to happen when people want to make domestic bets on the U.S. It's moving up in a similar fashion to what we saw in 2016 on the Trump win, if you looked at 2017 on tax reform, if you looked at 2018 on the trade war. So those were mostly domestic U.S. trades. My colleague Elsa Linos told me recently that she's seen sort of a similar kind of sudden upward move in dollar positioning. So I feel like maybe we're starting to get some U.S. bets that are being made again.
Just a subtle shift towards the former president, Donald Trump?
It's hard to say. I mean, we've looked at how S&P 500 is trading in regards to Trump in the betting markets. From 2023 through the middle of 2024, it was a very tight, powerful correlation. It broke down the last couple months, and I think we have to watch right now with the betting markets starting to shift. You're not really seeing the national polling averages shift yet. I think they probably will. But we have to see if markets are recoupling with Trump. It's not clear yet.
Things are still super tight. Laurie, it's good to see you.
Good to see you,
Laurie
too.
Calvasina of RBC. Top of bank earnings, investors also keeping one eye on more Fed speaking data, including retail sales. Nela Richardson of ADP calling it the most important data point of the week, noting two things. September's report tends to be softer with consumers prepping for holiday spending, but a sharper than expected decline could signal broader weakness. Nela joins us now for more. Nela, good morning. It's good to see you.
Good morning.
Let's go run with that word, weakness. And let's think about jobless claims last week on Thursday. They gapped out. They spiked higher. Can we start there? What's behind that? Is that all just hurricane related?
That's what we don't know. And that's what this period is going to be, very messy and hard to interpret. So the hurricanes usually have a very temporary effect on the economy. As we've seen, there's going to be a rebuilding effort. So we might see a little bit of slip in growth in the last 3 quarters of the year, followed by a rebound in 2025. But what's going to be more immediate is the effect on the labor market. It first is going to come with hours worked. Remember, in September, most of the jobs that were created, like a bulk of them, 2/3 in the private sector, were jobs that you have to be on site for. So retail, healthcare. If you look at the damage across the Southeast and the number of businesses that are still without electricity, going to work is going to be a challenge. And so that's what I expect to see, that hours worked really playing a role. And those hours are not just hours alone. They're going to feed into our measures of productivity, our measures of hourly earnings. And so I think that the October jobs report is going to be really, really clouded.
It makes me wonder, if I'm on the Federal Reserve sitting there November 7th, and hopefully we've got an election result in hand, and they're looking at these numbers, what will they get a clean read on, if anything at all?
They might get a clean read on retail sales, because that's probably not going to be as affected in the September data as the jobs market. And they're going to be really focused on the health of the consumer in terms of whether they might need to make an aggressive cut or not. If the consumer stays relatively balanced, which they've proven to be very resilient through the summer, then I don't think they're going to need to do anything drastic when it comes to worries about the state of the economy.
Do you feel like there is some sort of weakness, or do you think in the data that you see at ADP, it's just simply companies that are reluctant to make a big move? Sort of becomes this self-fulfilling cycle of not having confidence to hire, and so then that doesn't get back into the economy, so it just sort of chugs along at this very low rate.
We saw hesitancy over the summer. There did seem to be this feeling that companies were holding back a little bit, and not because of economic weakness, just that there's a lot of uncertainty, and that uncertainty can lead you to delay decision making. Well, a part of that uncertainty was kind of corrected when the Fed started their rate cutting cycle. We knew now that we were on the path to lower interest rates, and it seemed to thaw some of that hesitancy, and we saw a big jump in hiring in September. Now, what happens in October, I don't know, because the uncertainty has returned in a different form with the hurricanes, and where most of the jobs we're seeing is with service providers. We don't know how global or national companies are going to be looking at the hurricane damage in the Southeast, and maybe fine-tuning their hiring plans even more.
Just to put together what you were saying, the idea that retail sales is possibly going to be even more important than some of the employment data, simply because that's going to be so distorted for the Federal Reserve. Is there a feeling that retail sales could drive business decisions? Because essentially, if you don't make a decision to lean into this kind of strength, that's on you, and that companies eventually will have to realize that.
Right. These next 3 months for retailers are hugely important. They make about 20 to 25% of their revenue over the holiday season. And so yes, in some sense, they're going to have to skip over any kind of hesitancy and lean into what we're seeing so far, which is consumer strength. And you want to play into that, especially if a big share of your revenues for the year are going to be in the next 3 months. So I do expect some hiring, but I also expect some caution in certain regions. And so we'll see how that plays out over the next 3 months.
You expect some hiring. It's the absence of firing that stood out for us all.
Yeah.
And then we just see this big contradiction on Thursday with jobless claims spiking. Where are we on layoffs? How do you view things? Because the job openings data that we get, it's a little bit dated. You get a real-time look at things at ADP. Where are we with hirings and firings, more particularly?
Well, the trend overall, and we have to always look at the trend and not just a single data point, especially when we know that that data point could have been affected by weather events. But the trend overall is people are staying on the jobs longer. And that's both voluntary quits and involuntary layoffs. So there hasn't been a lot of moves in terms of the overall headcount. And the hiring we've seen has been expansive hiring, not replacement hiring. So that's good news. Now, there are some sectors that we've seen some downturns in manufacturing and in information, but overall, in terms of the service industry, it's been really, really strong.
The Federal Reserve has a bias to cut interest rates at the moment. Raphael Bostic, who's going to be a key policymaker in the months to come, particularly with the hurricane damage across his region, suggested skipping a meeting.
How do you feel about skipping a meeting? Given all the contradictions in the data, the murkiness, why should the bias still be to reduce rates?
Well, about 3 months ago, I actually said this, that it's going to be likely that there would be stops and starts in monetary policy, that they would not be on a smooth glide path because of all of the uncertainties in the economy. Yes, the economy is strong, but every month you get a new narrative about the future direction. And I think the Fed is very susceptible to that. And these weather-related events don't make it any easier. So yes, I do think that that is a real possibility that they may skip meetings in order to figure out what's going on in the economy. And that is related to their strategy, which is to be data dependent. Maybe it's time for a rethink on that strategy to be a little bit more long-term. I feel like we're kind of playing hopscotch with data. We just hop and leap from one data point to the next. I don't think that's a really viable strategy that you want to see with the Fed long-term.
The ECB is not playing hopscotch. They've got a pretty clear message, and they meet on Thursday. How much can we conclude this period of time that the U.S. has truly diverged from Europe when it comes to economic trends?
Well, that divergence has been in play for all year, right? So the labor market is strong. To be candid, I mean, there's some parts of Europe that are doing much better than expected, like the UK, for example, which was thought to be going into recession a year ago, and they made it through that period. They're still going to see the same kind of labor market tightness that we see in the United States. Those are long-term demographic effects. But when it comes to the U.S. economic story, it is unique and separate and apart from any other place in the world right now. You see a healthy consumer, you see strong business investment, you see a stock market that keeps growing, and you see a very strong labor market. So all those things added together put some distance with the rest of the world, and it's really the U.S. that is driving the world economy right now.
How much, when we're talking about China, the fact that there's sort of this deflation and there's a sense that growth is really falling off a cliff, how much do you see that not at all affecting the U.S., that these two economies have really grown apart, even though we are seeing it trickle into Europe in a much more meaningful way?
It's interesting, the U.S. economy, because we think of it as a global economy. But there's parts of the U.S. economy that is insulated from global effects, our energy, for example. And so, yes, I do think that China, being the second largest economy in the world, will eventually affect the United States. But how much is undeterminate. I do think that there's still some tailwinds in the U.S. economy that even allow us to grow past weakness other places.
Nela, you're one of the best. It's good to catch up. It's good to see you.
Thank you.
Thank you. Nela Richardson of ADP. More of BlackRock is looking ahead to earnings. Even with our balanced optimism about 3Q results, we are more focused on how management guides for 4Q and into 2025. We want to hear management teams express confidence about their ability to deliver revenue growth, to manage expenses, and to navigate policy and political uncertainty. Three very different themes. Kate joins us now for more. Kate, good morning. It's good to see you.
Don, I'm a little sad. I didn't realize I was coming here on the anniversary of the bull market. I would have dressed differently.
How should we have dressed? Like with red ties and hearts and stuff like that?
Yeah,
Thank
maybe
you.
a tiara. I mean, it's quite a celebration. In fact, and I feel really good about the fact that equities continue to make new all-time highs and that the fundamentals look really solid this far into the cycle.
Let's start with top-line revenue growth. Where's it coming from? How much confidence do you have that we'll get more of that through 25?
Well, this was the big question, right, as we went through second quarter reporting, where, you know, companies were putting up good bottom line numbers, but the top line was really disappointing on expectations. This kind of quarter, we've seen a bunch of solid activity. We've seen good incomes. We've been, encouraged by the fact that inflation has continued to slow. And I think we're going to see solid, but not blockbuster revenue growth in the third quarter. The real chance is going to be if we get into next year and some of the uncertainty is removed. I think people will feel more comfortable about increasing their activity. I mean by people, I mean both business decision makers and individuals.
One of the reasons why maybe you didn't realize it was the second anniversary, and John didn't sound overly enthusiastic about it, although happy anniversary. I do think it hasn't felt this way. Right. It has not felt like a bull market. It has felt like a grind of lots of different narratives that are coming together with whipsaws in between and a couple of behemoths that have absolutely led the charge while everything else had a soggy performance. When will it start to feel like a bull market?
Well, you're right. There's been a huge amount of discomfort in the leadership and the strength of that leadership, the persistence of the leadership, a message that we've talked about many times, and I feel like I have been a broken record, is to say the companies that have been leading the market are the strongest fundamentally. These are the companies putting up the cash flow. And I expect that will continue into 2025. How many times this year, by the way, have the uncomfortable, equity investors said it's time for rotation, the market's supposed to broaden out? Well, it's only going to broaden out if these top companies actually don't have the same growth trajectory that they've had over the last 2 years. And I don't think that's the case. I mean, I think parts of tech and the AI adjacent themes still have a lot of legs to go.
So given that, are you basically recommending that clients overweight stocks, even at the behest of bonds, at a time where the biggest uncertainty might not be in the stock market, but at this point really is in the bond market that's closed today for a celebration of the second anniversary of the bull market?
Yeah, that's correct. The bond market got the celebration correct. I would say this, we have been more neutral in terms of our fixed income allocation. I still think you're going to get the best juice from the equity market. But again, you have to pick your spots. The one thing that has happened throughout this past year that people have not always been comfortable with is that you have had to be tactical and you had to have to be on your feet. I don't think the kind of the set it and forget it strategy is going to be the way to go forward in the equity market. And so for this, I would say, I told you I love the tech and the AI and AI adjacent themes. I think there's opportunity more in the banks as we move forward. And I'm looking, if we continue to have stable growth indicators, for opportunities in some of the cyclicals. But there you have to be selective.
You identified 3 themes: top line growth,
yes,
expense management, and then navigating policy and political uncertainty.
That's right.
How are they going to navigate the politics of the next month, maybe the next 4.5 years?
Well, I don't think they're going to make a ton of decisions in the near term. I mean, this is the pattern we always see. The second half of the year during a big election cycle, you don't tend to get a lot of capital expenditure or new capex. It's mostly maintenance, for example. And consumers have said in a lot of polls and surveys more recently that they're kind of holding off on making big decisions till they understand what their tax rate is going to be if there's any changes in policy. So I think we're in a bit of a holding pattern, John, for at least, the next few months. But next year, once we understand not just who is going to be president, but the composition of Congress, I think there's going to be a willingness to kind of embrace whatever that policy is and move forward.
This, to me, is one of the biggest question marks. We hear about policy uncertainty. We hear about questions about potential for growth in terms of earnings and margins. We hear about a reticent investor who's holding on because of risks. And then we see a 5th straight week of gains in the S&P 500, the longest streak, as John was mentioning, going back to May. How do you square what seems like a lack of confidence in surveys and a demonstration of confidence when it comes to allocations, inflows, as well as just performance?
Look, sentiment has to be a big part of everyone's investment process. And when you have all these sentiment indicators, the surveys, even some companies saying that they're concerned, that's the moment you say there might actually be opportunity. Right? When everyone is saying it's an all clear, there's literally nothing for us to worry about, we're going to pile all of our risk into the riskiest parts of the stock market, then you kind of have to back yourself off. I think in this case, the fact that people have been more reluctant bulls, that there has been, a fair amount of argument around the leadership, that sets us up well, I think, for positioning. And I think the stock market is not overly owned at this point. There's still a little bit of cash on the sidelines. And if these tech companies in particular put up big numbers in third quarter reporting, there's room to re-up those positions, I think, going into year end.
Kate, this was great. It's always good to see you.
Yeah, great to see you.
Thanks for being with us. Kate Moore of BlackRock.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.